If you're in the world of auditing or risk management, you already know that not all risks are the same. Today, we're going to break down the different types of operational risks, the kind that can really, and quietly, disrupt a business from the inside out. Hey everyone, welcome to the Audit Guidebook channel. Whether you're a student just starting out, a new auditor getting your bearings, or even a seasoned pro looking for a quick refresher, you are in the right place. This explainer is a key part of our Module 2, A Practical Guide to Audit, where we're all about clear, actionable insights you can actually use in the field. So here's our game plan for today. We'll kick things off by defining what operational risk really is. Then, we'll dive into the main categories: people and process, systems and fraud, and finally, external and compliance risks. And of course, we'll wrap it all up with a quick summary to make sure everything sticks. Okay, let's get right into it. Before we start sorting risks into different buckets, we need to build a solid foundation. I mean, what are we really talking about when we use the word risk in an audit context? At its very core, risk is just the chance that something could go wrong. It's any event that might stop a company from hitting its goals, whether those goals are about running the business smoothly day to day, meeting financial targets, or just staying on the right side of the law. Now, let's zoom in a little bit. Operational risk is a very specific type of risk. It's the threat of loss that comes directly from the everyday business of, doing business. Just think of it as the risk of a breakdown in one of the four main pillars of any operation: your processes, your people, your systems, or even things happening in the outside world. So where do these risks actually come from? Well, they can pop up from controls that are weak or just badly designed. They can come from simple human mistakes or, on the flip side, deliberate fraud. Technology can fail us, or huge changes in the world can throw a wrench in the works. As auditors, these are the root causes we're trained to hunt for. All right, let's get into our first major category. We're going to start inside the organization, looking at the human and the procedural side of things. Honestly, these are often the most common and, frankly, the trickiest risk to get a handle on. People risk is pretty much exactly what it sounds like. It's all the risk that comes from the actions, or maybe the lack of action from your team. And this can be anything, right? From an honest mistake made by a brand new hire, all the way to a calculated, unethical move by senior management. It really all comes down to the human factor. So, what does this look like in the real world? Well, picture this. An employee deliberately bypasses a safety control just to push through a payment they know isn't authorized. That, right there, is people risk in a nutshell, a failure that started with a person's decision. And working hand in hand with people risk is process risk. This time, it's not about the person doing the job, but about the playbook they're supposed to be following. If your internal processes are broken, badly designed, or just nobody's following them, you've got a huge risk on your hands, no matter how great your people are. We're talking about gaps in procedures or just total confusion over who's supposed to do what. And here's a classic example for you. Let's say a company has really weak procedures for reconciling its cash at the end of each day. Because of that weakness, errors or even theft can go completely unnoticed for ages. The process itself is the point of failure. Okay, next up, let's look at two risks that are super closely related but have one critical difference. One is about the tech we all depend on, and the other is about a deliberate choice to deceive. I mean, let's be real. In today's world, almost everything runs on technology. So systems risk is the danger that this tech fails you. It could be a server that crashes, a software bug that corrupts all your data, or, of course, a cyber attack that brings the whole operation to a grinding halt. And a very real-world scenario is a core system just going down. Think about it. If your main transaction processing system crashes, the business just stops. No sales are happening, no service is being provided. That's a direct operational and financial hit for every single hour you're offline. Now for a risk with a totally different flavor: fraud. The absolute keyword here is intent. See, unlike an honest mistake or a system that just breaks, fraud is a deliberate, calculated act of deception to get something of value. And it can come from inside the company or from the outside. So, what's a textbook case of internal fraud? Imagine an employee who starts creating fake invoices from a supplier that doesn't even exist and then directs all the payments for those fake invoices straight to their own personal bank account. That is a planned attack designed to exploit a weak spot in the payment process. All right, let's move on to our final two categories.
One of these deals with forces that are completely outside of a company's control, and the other is about the complex web of rules that every company has to play by.
External risk basically covers all the big, scary things that can go wrong out in the world that can directly hit your operations. We're talking about natural disasters, political chaos, or, as we all know too well, global pandemics. A company can and should prepare for these things, but it can't control them. Just imagine a factory that's built near a river. A massive flood could completely wipe out critical equipment and shut down production for weeks, maybe even months. That is a perfect, devastating example of an external event causing a huge operational failure. And last but not least, we've got compliance risk. Every single organization operates under a whole set of rules. We're talking laws, industry regulations, contracts, you name it. The risk here is failing to follow those rules, which can lead to massive fines, messy lawsuits, and serious damage to a company's reputation. A really powerful example, especially if you're in finance, is anti-money laundering or AML compliance. A bank that doesn't follow these super strict rules isn't just risking a slap on the wrist. It could be facing millions, even billions in fines and intense regulatory heat. The operational failure here is a breakdown of the compliance process itself. Okay, wow, we have covered a lot of ground. So let's take a second to pull all of this together into a clear framework that you can take with you and use. This table really sums it all up nicely. First, we had people risk, which is all about human error or misconduct. Think employee fraud. Then there's process risk, coming from weak procedures, leading to things like unreconciled cash. We have systems risk from IT failures, like a server crash. External risk from events you can't control, like a natural disaster. Compliance risk, which is breaking rules like AML regulations. And of course, fraud risk, the intentional act of stealing, like creating those fake invoices. This right here is your core toolkit for spotting operational risk. So, I'm going to leave you with a question to think about. As you look at this whole landscape of risk, everything from human error and cyber attacks to regulatory changes, which one of these do you think is the single biggest threat that companies and auditors have to deal with today? It's definitely something worth considering as you apply these ideas out in the real world. Thanks so much for tuning in. If you found this breakdown helpful, please do us a favor and hit that like button and subscribe to the Audit Guidebook channel. And for sure, check out the other practical guides we have in our Module 2 series. We'll see you in the next explainer.